begin the next Q&A session, please raise your hands and I'll call on you. I will try to make sure we get everyone included with at least one question. Please limit yourself to just one question so we can make sure we get to everyone. With that, we'll take our first question from Josh Silverstein from UBS.
Hey, thanks. Good morning, guys. Just for the volume outlook, can you just talk about how much is already under FID to give us confidence in that 2 to 3% growth outlook? Because there was a big focus on exploration here. So is that more upside driven versus what you already have locked underway? Thanks.
Yeah, thank you, Josh. If you step back and look at this message about a greater than 10% CAGR on free cash flow growth, it is front end loaded, and that's why the confidence is so high. In addition to that, we have opportunities for the future. So let's just run through what's driving production in the short term. You'll have full year of our bringing our Hess assets on. You've got the TCO that's now over 1 million barrels. Permian settled in over 1 million barrels. You've got Eastern Mediterranean starting to grow. You've got Australia steady. And you go to the back part of the decade and you've got Guyana, Eastern Mediterranean, and Argentina. So you've got series of growth patterns over that 5, 6, 7, 8 year period. They give us high confidence in our ability to grow production 2 to 3%. Thanks, Josh.
We'll take our next question from Jeff Jay from Daniel Energy Partners.
Hi, can you hear me okay?
Yes.
I really wanted to follow up on the advanced chemical treatments. I was looking at the appendix in slide 46, and I guess my first question is, the uplifts look impressive, but how different are these chemical treatments than what you were doing before, both on new well treatments and base well production, and how differentiated are they from what your competitors are doing?
Well, first off, thanks for getting to the appendix so quickly. Greatly appreciate that, Jay. Jeff, if you think about how we've performed in the Permian, one thing I'd want you to step back and recognize is we just continue to improve. That's the benefit of a factory and a plateau. When you think about our very, very visible results on EUR today, that appendix is placed there so that you can go back on your own, look at specific well data with Enverus and others, and see what difference is being made today. If you were to summarize what was on that appendix slide, it would leave you with the following: a 10% EUR bump, right? It would decline reduction of 6 to 8%. Given that we've worked this over our whole system, the ability to reduce the cost of that additive 50%. So you could get break evens as low as 4,000 barrels. So the reality here, we are now applying that to essentially every new well in the Permian, and we're beginning to test it in some of the other basins. When you compare that to competitors, it's an industry where there are no secrets, right? Much of what we're doing today is actually proprietary from our own specialty chemical company that makes surfactants Oronite. So we really like the cocktail we've created to date, and I would only expect more of that to come. Thank you.
We'll take our next question from Betty Jiang from Barclays.
Thank you. Question to you, Jeff. So power. You guys laid out the 2.5 gigawatt in West Texas, expandable to 5. I think that's a huge project and a huge footprint. Could you just speak to the customer base? Like, do you foresee a hub of hyperscalers? Would that project be supplying power to your own operations? Just so speak to the scope of that project, and then also the mid-teens return. What's baked in and what's not baked in? Thanks.
Yeah, so thank you for the question, Betty. We are in exclusive negotiations with a customer on the site that we have laid out here on the slide that you see in front of you. There could be additional customers that come into this over time. We're in the midst of these commercial negotiations, but the demand in this space and customer interest has been high leading up to these exclusive negotiations, and it still is high. We have many inbounds coming with other customers who are interested in what we're doing in this space. But we're focused on this one customer and concluding these negotiations that we have underway. I think in terms of supplying power for our own operations, That's not in our current plans. This would be more or less exclusive behind-the-meter power to very large-scale customers whose desire for this power on a short time frame seems to grow and grow and grow. So powering our own operations, we do use renewable power, electrified many of our rigs in the Permian, but that wouldn't be the purpose here. We're really dedicating this to this one customer. On returns, I'd go back to what Mike said in his comments. This is a fast-growing space. Demand is far exceeding supply for power in the U.S. There are repercussions of that across the country. This is a space where we bring differentiated capabilities. We operate large-scale behind-the-meter power all around the world, where high reliability for some of Mark's operations are very, very important. So we're translating some of those same skills into this space. Importantly, we think we've built a very competitive project. It is underpinned by the large natural gas resource that we have in the Permian. Customers like the low-cost resource and the long duration of this resource, but it's also underpinned in our early actions to secure equipment, to secure a site, to select an EPC, to start the permitting process so we can meet the customer demand that you see up there on the screen. That gives us confidence in that context as we enter these commercial, or as we're in these commercial negotiations, we're able to not just target, but almost require mid-teens returns to underpin our investment. We have not concluded those negotiations yet. We will remain disciplined and value focused like we do in all parts of our business. And hopefully when these conclude, we'll be able to announce an FID decision and we'll provide more details in due course. Thank you.
Take our next question from Philip Jungwirth from BMO.
Thanks. You showed Permian production at plateau through 2040. It looks like you have the sticks identified with the NPV chart, but was hoping you could talk through the visibility here for non-Chevron operated barrels. And then how should we think about the option to grow, whether it's the magnitude, is this kind of a call on broader Permian growth, or is it more Chevron operated activity that could increase at a higher oil price?
Philip, thank you for the question. When you think about the Permian in general, our confidence level in getting through 2040 at this type of plateau just grows every year as it continues to take less capital, as we apply some of the EUR examples we described earlier. Despite having been at this, I mean, if you step back to 2020 when we first mentioned the plateau of 1 million barrels, we've grown 75% since then. Given some of the improvements we've seen in our drilling costs and completion times, we're going to end this year at the low end of our capital range of 4.5. So we'll be down to the 4.5 range of capital, starting next year with 3.5 to keep that, $3.5 billion to keep it, the 1 million barrels going. That gives us a lot of room going forward. Today we're 50 to 55% company operated, so today. And I think as you look forward, the NOJV acreage that we hold is in some of the very, very best basins operated by some of the other large operators. So it gives us confidence that that rate will continue going forward. So I think you'll see our balance between, say, 50 to 53% co-op, 30, 32% in the NOJV space, holding for the remainder of this decade and into next decade. So it's all about the quality of the acreage and our ability to continue to reduce the inputs to get those outputs.
Take the next question from Devin McDermott at Morgan Stanley.
Hey, thank you. So I wanted to come back to the AEI opportunity in the business. That's something that you talked about, some of the applications so far, and also it's interesting that it's not yet embedded in the plan when we look out through 2030. And I think, Jeff, you quantified it for us a little bit, that you see billions of dollars of potential value creation over the course of the plan. So can you talk a little bit on where you are in rolling out some of the high impact applications that you cited? And then where should we look to see the biggest financial impact? Capital intensity, operating costs, margin capture, something else?
I think we'll see impacts in all of those areas. Before I get to the kind of the high impact opportunities, transformational opportunities, we've been on this digital journey for many years. This has been a priority for our company for a long time. We're now using some of the next level AI tools to just scale those efforts up. I talked about creating a central AI-focused team about two and a half years ago, which really started to get into this. There's three kind of areas that we're focused on. One is just overall workforce productivity, getting the right tools in all of our employees' hands. And already, well over half of our employees have access to cutting-edge tools. We're encouraging them to use them each and every day. You're already seeing value just in individual productivity across the company. Some of the tech relationships we have, which we're now expanding with some of our power-related work, helps facilitate that. But that's one. Two is, which is related to that, is transforming some workflows. Existing workflows in the company. We went through a massive operating model change that was asked in the earlier session. We have better visibility on our workflows across the company and how work gets done than we ever have. And now using AI tools, not just to speed up decision making and lower costs, but to improve decision making. And the list of areas that we're already seeing benefits in this, in our business, is too long to get into today. But what we're most excited about are some of the transformational opportunities. I think watch a few spaces. Our shale and tight business, both subsurface impacts. You saw some of that with Apollo. Taking large-scale data, we have the visibility into 1 in 5 wells, unmatched in the basin. Marrying that with some of these AI tools to create AI systems where you make better development systems, or better development decisions, better design decisions, better when you get to the surface and moving molecules, better commercialization decisions. I think that's where you really see the value expand. We've made progress in this space, but we still have a lot more work in front of us. You might speak to exploration.
Yeah, well, I was going to go actually to, Emer and I were recently in our engineering center in India, and the good news and the bad news is I've been around a long time. And what it used to take to go get information to plug and abandon an old well. In the old days, you first had to go find all of that information. You had to sift through it all, create an application, put the orders in, put the permits in. When Emer and I were in India here recently, the Australia team went to bed, and then the next morning, the team from our India operation had the permit application, what was necessary to plug and abandon a particular well, and all the orders placed. That's massively more efficient, and it's repetitive. So there are these transformational activities, and it's changing our everyday work activity. When you standardize and centralize, it gives you a chance to do more of that, which is opportunity for us going forward.
We'll take our next question from Doug Leggett at Wolfe Research.
Oh, excuse me, thank you. Mark, I wonder if I could kind of try and connect some of the things you've talked about on the growth, particularly in Guyana, with what Emer was saying about the cash flow growth. And I want to pose a question like this. ExxonMobil has talked about 1.3 million barrels a day of production by 2030, but there's 4 incremental FPSOs at round numbers of 900,000 barrels a day of incremental capacity. My question is, what are you assuming in your 2030 targets? I just looked on the visualization site. We're at 800,000 barrels a day of production in Guyana today, so that would mean Exxon's number is 500,000 barrels a day up from here, but there's 1 million barrels a day of capacity coming online. It makes a heck of a difference to your 2030 cash flow numbers. So what's embedded in your assumption?
Yeah, so first off, we're so excited to have Guyana as part of the portfolio. It is a world-class asset, and with 11 billion barrels of resource and our per share holdings in that, we benefit more than anybody by the upside in Guyana. Today, everything that we have shared today reflects the operator's view. Nothing different than what the operator thinks. That's what a good partner would do. Do we see upside potential? When you think about 11 billion barrels, big fields getting bigger, although we haven't forecasted, I would expect upside. And as a partner, we'll do everything in our power to help find that. There's still time for exploration. There's some deeper reservoirs to test, and we look forward to working with a partner to do that.
We'll take our next question from Neil Mehta at Goldman Sachs.
Thank you. I want to flip to slide 30 when you talk about some of the other shale basins, and specifically, Mark, as you think about the Bakken, would you characterize it as core? I think it's clearly a key part of the plan. And then Argentina's gotten less attention maybe during this session. I know there's a lot of moving above ground issues there, but curious on how that competes for capital in the portfolio.
Well, so let's start with the Bakken. This is another asset that happy to have in the portfolio, and maybe to comments that Eimear and Mike made, it's the people that are impressive in reality. But having the Bakken in our portfolio today, the Hess team did a really good job of building production up to around that 200,000 barrel a day range. It played a certain role in the Hess portfolio. It naturally plays a slightly different role in the Chevron portfolio. So producing around that 200 million barrels a day is the target for us. At that level, we can apply all of our best practices. So today, you've already noticed this, we have reduced rigs by 1. So we're down to 3 rigs versus 4 at the same production level. We have reduced the number of workover rigs by 5, allowing kind of maintenance activity to be a little bit more efficient. As I commented in my prepared remarks, we are increasing the length of laterals in the geography in that particular basin, and you'll see us even do some 4-milers. We have been catching up to do, I think, versus the competition in that regard. And we're introducing the first integrated oil control center there in the region. So all of that leads us to holding near that 200,000 barrels a day and just reducing the cost to do so. I think we're just scratching the surface in the Bakken. So more to come. And everything that we view in the Bakken includes our 38% holding of the Hess midstream in our consolidated reports. On Argentina, we've talked a long time about the quality of that acreage. In my prepared remarks, we talked about tripling, to the 180,000 barrels a day. There's nobody really debating the rock. So it's between the rock and then the above ground risks there. From a geology standpoint, we said in our materials that it was 75% oil weighted. I would also leave with you that on a lateral foot basis, EUR is 50% higher in Argentina than the average Permian well. So clearly the geology is good. The next thing you need to do is make sure you have infrastructure to get it to markets. You have seen our action in participating with an export pipeline that is under construction as we speak, getting that crude to product. And that crude, with blending, competes nicely with Arab Light, so it'll be a highly desirable crude. The challenge today would be kind of the overarching cost of doing business in Argentina. And the current administration is taking actions in this regard. Today, it costs us 35% more to drill a well in Argentina than it does the Permian, despite the strong geology. Given some of the actions that are underway with the government, our hopes would be that capital controls would be reduced, that some of the tax burden and workforce flexibility would be increased. So taxes coming down, ability to manage people, and then the opportunity to bring in the absolute best technology, I think is going to be critical to unlocking Argentina. We have the ability to accelerate, like much of our portfolio. We think we've paced it right now to keep up with the reforms that the government's working on. Thanks.
We'll take our next question from Sam Margolin at Wells Fargo.
Hey, thank you. I wanted to ask about gas and power integration. You have this slide on gas sales mix. It looks like you got a slug of power indexed gas that you expect to come with the projects. I think that'll grow after 2030 because the capacity's ramping too, so maybe it'll be commensurate with that. But it has significant effects on your Delaware Basin operation. You still delineate number of locations by oil price, but if gas is higher, the number of locations will be influenced by that too. And also, like on the type curves, if you have GOR effects that aren't expressed in the type curves, you're less sensitive to that if you have gas realization tailwind. So, can you just talk about what you guys think internally about the economics of sort of your Delaware Basin asset with a gas and power integration?
Sure. Thanks, Sam, for the question. When we entered this space about a year ago, we made the announcement in January that we had secured 7 large-scale frame turbines from GE Vernova. We had an idea of where you might be able to build out large-scale power in the U.S., and we knew Permian would be pretty high on that list. One of the reasons we really like doing this in this basin is given not just the large natural gas resource base, but the duration of that. You're talking about very large amounts of natural gas to deliver the power that we had on the later slide at a very competitive cost, more competitive than I think almost anywhere in the country. That's been very attractive to customers, which is where all of this starts. We need to be able to attract the right customers to sign long-term power purchase agreements that meet our return thresholds. I'd say it starts with the location in this very large natural gas resource base. To get to your question, we also like the fact that we're a large natural gas producer in this basin. And as you all know, gas trading around the Waha hub, the West Texas natural gas hub, trades at a significant discount to Henry Hub. At times it goes to zero or even negative. There is an added benefit for us, Mark's business, in attracting new customers in the region and not having to move it to the market or to international markets. We want to do all of that. But there's an added economic benefit for us in just sourcing demand in the basin. And so we like both of those aspects of this. I'll let Mark talk a little bit more about it.
Yeah, to pull on the thread, Sam, all it does is it makes our shale and tight businesses stronger, right? Simply because you have more options as to where to put today would be 3 BCF of gas. We have taken some longer-term LNG offtakes in a capital light way to create some other optionalities into the future. This is just one more option to ensure that the net margin for all that we produce in our shale and tight portfolio gets to market at a higher price. And so I think it does help over time continue to drive value into the shale and tight businesses over time.
Take our next question from Arun Jayaram from JP Morgan.
You mentioned that you expect Permian CapEx to go to about $3.5 billion next year. I was wondering if you could help us think about the trajectory of lower 48 capital over the forecast period through 2030.
Yeah, so I think for our entire $18 to $21 billion of capital, about half of that happens to be in the United States in its entirety. I would expect in the Permian in particular, you're going from 5 to 4.5 to now 3.5 billion. I would expect us continue to try to drive that down over time. It's what we do every day, and that just means more cash for all of us. But just over half of our capital budget's in the U.S.
Take the next question from Nitin Kumar from Mizuho.
Great. Thanks for taking my question. Mark, I wanted to touch base on one of the earlier comments you made about the LNG offtake. It's new, 7 MMTA, but it's also earlier than some of the other deals that we've heard of. Earlier, Mike said that you expect the LNG market to be oversupplied till the end of the decade. So just kind of curious if you could help us put the pieces together. Why the offtake and sort of how is that part of Chevron's macro view?
Yeah, thanks, Nitin. I appreciate the question. It helps to maybe step back first and look at the context, and Mike touched on this a little bit, but our LNG portfolio today starts with world-class assets in Australia. Very, very reliable. Now a low unit cost of production, keeping those full with the 40 TCF of gas that's available in Australia. That's kind of the anchor of our LNG position. Mostly point-to-point, mostly oil-linked contract. We now have a full plant in Angola, so Angola LNG, and a small plant in Equatorial Guinea that allows a little Atlantic margin exposure. But then we have this 3 BCF a day of gas coming out of the associated gas out of the United States. So our opportunity was in a time where we could get some of the very, very best capital light unit cost for offtake out of the U.S. Gulf Coast, to lock those in for the next 20 years to ensure that we would have options for margin in the future. On timing, about half of these come on towards the end of this decade, and the other half come on early next decade. So it's spaced out a little bit over time, but maybe to reinforce the points that Mike make, you shouldn't see us having large spot exposure in LNG, nor should you see our portfolio shift to something other than oil weighted. Thanks, Ben.
Next question will come from Samantha Huh from HSBC.
Hi, thanks for taking my question, and thanks for all of the information on the power gas piece. We're starting to see a lot of news flow coming out about data centers being built globally, and I was wondering if you guys have started to do the work in terms of other markets that are attractive, and what type of returns you would require to maybe expand into those markets.
Thanks for the question. We have done some we've looked at this a little bit. We have gotten some customer interest in this, specifically, and kind of going around the world. Where might this work? Where do you have a very large natural gas resource base at a low cost? Obviously, there are parts of the planet where you may be able to replicate this. We are very cognizant, though, of some of the political realities of this data center build out. The competitiveness of it. There are additional risks depending on where you were to build some of these, especially where some of those very large natural gas resources exist. So what we're focused on today is where we think we can put together the most competitive project really anywhere in the world, and that is in West Texas. 5 of the 7 turbines are dedicated to this first project. And we're in exclusive negotiations with a customer on that. We're looking at options for the other 2 turbines. Expect those to be in the United States, and expect Texas to rank, pretty highly on that list.
We'll take the next question from Biraj Borkhataria from RBC Capital Markets.
Hi, thanks for taking my question. I wanted to ask about the TCO debottlenecking slide, because that 20% uplift over a long period of time, but that clearly adds a lot of value. Obviously, we're at a new baseline now. How should we think about debottlenecking potential going forward? And also in terms of the timeline, given the current concession ends in early 2030s, your willingness to pursue that. Thank you.
Yeah, thanks. Thank you, Biraj. I think the example of think back to, what was it, 2008, when the second generation plant was built, and the 20% debottlenecking that occurred before we made our recent investment, which is on the slide there. That's one of the reasons we're a partner that we think should continue on in Tengiz. The ability to work with the Republic to maximize the value of what is a highly complex reservoir is part art and science, and we believe we deliver all of those things. Given that debottlenecking is such high return and can happen so quickly, we think all parties are aligned to begin the journey on debottlenecking as we speak. In fact, I think we mentioned in our third quarter call, we have a pit stop that's and we may be happening starting as we speak. We're going to make some adjustment on some trays to maybe even expand some capacity in one of the splitter columns. So short answer is debottlenecking begins today. It's no different than Anchor, a platform we celebrated earlier. Next year, we'll spend probably $9 to $10 million, add a third of capacity to Anchor. Debottlenecking is something that we do. It's the thing that isn't as exciting sometimes, doesn't always get the headlines, but that's real barrels, and it's the highest return investments we could make. So I would expect progress shortly. Thanks, Biraj.
We'll take the next question from Paul Cheng at Scotiabank.
Thank you. Mark, on the West Coast downstream, we are seeing a lot of changes. And given your position on the infrastructure, even though that your property is balanced, you don't need to import. But when we take into consideration of your Asian position in whether it's in Korea or that in Singapore, does it make sense for you trying to become a consistent importer into that business, into that, even though that you don't really need that extra supply? Or that you think that from a business case that that's not something that you want to pursue? And also that there's a number of pipeline proposal. Will you be willing that to commit to be a shipper there? Thank you.
Thanks, Paul. You can't have one of these conversations without talking about California, right? Yes, maybe to step back just a moment. I think I would say that what you're seeing today is a result of decades of policy, right? So it wasn't all that long ago that I was a resident of California. I'm a little bit worried that it's the California energy users that are getting punished in all of this. But the reality today is when you have two world-class refineries and you own a lot of your own infrastructure and you have the best brand in the market, we can watch all of these things happen and choose to participate as we think it's best for ourselves. So we are advantaged today. Despite the fact that a couple of competitive refineries are shutting down, I would leave you with it took decades of policy to create what's happening today. It will take decades of policy improvement to get out of it. So we will watch pipeline activities very closely. We certainly will do our best to operate reliably and take care of the California consumer, but we're better positioned than anybody to figure out that path as it becomes clear. And on these pipelines that you're talking about, remember we're connecting from a market that uses that product today that has to be made in California specifications, then it has to pay tariff number 1, tariff number 2, then it has to land in the market to compete. And so, we'll put our cost of supply up against anybody today. We'll put our cost of supply up against anybody. So it takes having it come from Korea in a ship landed in California, it's hard to beat a world-class refinery delivering that same product. Today, we're in a good position to do that. Could we go to imports? Certainly.
We'll take our next question from Ryan Todd at Piper Sandler.
Great, thanks. As we think about some of the technology that you talked about in Titan Shell, whether it's chemical treatments or Apollo that you demonstrated, how should we think about the timeline at which these technologies are applied across the portfolio, the timeline at which we start to see improvements, and the outlook of current production and CapEx? Does it include any of those assumptions in terms of uplift? And maybe finally on that whole thing, how do you balance, if you get greater productivity per dollar spent, how do you balance the opportunity to either exceed growth production targets or lower CapEx?
How about I start and then you close out? So I'll kind of start where you ended. The opportunity to continue to improve, whether it's technology or other type of efficiencies, that's the advantage of a factory. That's the advantage of staying over 1 million barrels, but staying in that range. We can apply those things, continue to reduce the capital that's spent or the resources required to generate more cash. That's our current view today. What's so nice about our portfolio is we have the option to accelerate that in the future, but today it would simply drive more cash to the bottom line. That would be the way we think about it in the short term.
I'll repeat some of the things I said earlier. We see this as a really big opportunity, Ryan, and we are differentiated in the data that we have. We've talked a lot about shale and tight and all the things you can do to drive better subsurface outcomes, including recovery, but more recovery faster, and all of the development decisions and design decisions that go into a very large resource base, and that's just in the Permian. If you think of the surface implications for this, over 1 million barrel a day, operating footprint, not all of it operated, but a large portion of it operated. The surface implications are also just as exciting. I talked about the way we can optimize value chains and moving molecules to the very best markets, but just managing our operating expenditures, moving to a more a proactive approach to maintenance as opposed to reactive. And we do a little bit of both today, But these tools can take this data that we have in this basin, the value to an entirely new level. We didn't get into exploration too deeply. You saw some examples of it in Mark's slide and in the opening video. You've got decades of data and a lot of it unstructured data, which is very hard to work with, almost impossible to work with. Now, feeding that all into some of these AI tools to make better lease and prospecting decisions to increase the probability of success for every exploration well that we drill. Small percentage improvements across a very large asset base lead to significant value impacts. I think in terms of timing, we'll continue to provide updates on this. We are thinking about this like a business. We invest money and time into this. We need to get money and value out of it. We've got targets for late next year, and we've got more aspirational targets for 2 to 3 years to the end of the decade. So more to come, Ryan.
Take our next question from Paul Sankey from Sankey Research.
Thank you, Jake. Well, Mark, you're talking about 2 to 3% volume growth. Does that mean that we anticipate more than that growth in the dividend over time? And is there ultimately a point where you reach a terminal size for Chevron, at which point would the dividend have to stop growing? And Jeff, the new energies has basically been something of a check the box on ESG, subsidize, grab the subsidies while they're available. I assume that the AI investment isn't subsidy dependent, and I was wondering what cost of capital and anticipated return you have from that business, which, as I said, I guess most importantly, isn't subsidy dependent. Thank you.
That was a creative two-part question, Paul. Well done. But I can make the first answer really, really short. Eimear could not have said more clearly that the priority for our company is a sustained dividend, growing dividend over time. So no, I don't see an equation where we have a portfolio that can't continue to do that over time, and it's our job to ensure that that happens.
And I'll repeat what we said earlier, Paul. We've been very pragmatic in this space. When we launched New Energies 4 years ago, there's a number of assumptions that you're making about future policy development, technology development, customer adoption. That's what this comes down to at the end of the day. That's been slower than what was anticipated. We're always value driven. I think what we walk through is lowering our carbon intensity is first. We have built a large integrated competitive renewable fuels business. We do have some options for future growth, but I think your question on the policy dependence, the technological improvement on cost, and ultimately customer adoption drives value. That will drive our behaviors in this space. AI, completely different space. Lithium could be a different space. Large-scale power for data centers seems like it's a different space. We still need to prove that out, but that's what we're focused on today. On AI specifically, I mean, a very high return on investment that we see today. Now, when you get into these next level tools, they don't come for free. And I think some of the partnerships that we've built in the power space will benefit us in the AI space. It's interesting to talk with them about how can I help you meet your power needs and how can you help us scale this. I think there's some differentiation in that as well. That won't be free, so we need to make sure we measure the return on these investments, and we'll use the same. We'll take a value-driven approach here, just like we do across all of our businesses. Thanks.
We'll take the next question from Lucas Herrmann from BNP Paribas.
Thanks very much, Jake. Can I just go back to the chemicals business? I'll go to CP Chem, and it's not an M&A question. It's simply you've got a lot of capacity coming on. Seems it's slightly later than you'd originally indicated. It's 27 now rather than 26, but that's not really the point. The point, Mark, for me is to try and understand the delta to cash flow that that's going to mean as the capex investment on those 2 mega projects comes out and the dividend, because it ostensibly starts to come through. What should we anticipate as the potential return at deck of moving from building non-productive to actually releasing capital? What do you anticipate in the budget or the forecast you're putting?
Yeah, fair question, Lucas. Thank you. In my prepared remarks, I tried to re-emphasize the strength of the CP Chem portfolio from a competitive standpoint. There are not many people in the petrochemical space that are running today over 100% utilization. So that means you have to be at the best part of the supply stack to do that. The project in Qatar and the project in the U.S. Gulf Coast, those are top decile projects. So it's important to reinforce where they will fit on the supply stack. One of the things that we chose to do with our CP Chem board positions was drive them to ensuring that they delivered safely and reliably at that portion of the supply stack. They did not have to hurry given market conditions, and so that's what you're seeing right now in regard to the first half of 2027 startup for both of those. If you think about the earnings potential or the cash flow stream into Chevron, it might be worth starting our CP Chem or Chevron ownership of these projects because of their partnerships with QE. So in Qatar, we're essentially a 15% partner in the cracker, and we're a 25% partner in the one here in Orange, Texas. The board at CP Chem targets a 50% of free cash flow as their dividend, and I think over the next couple of years, as the spend winds down, you should start seeing that come our way. Thanks, Lucas.
We'll take our next question from Jason Gableman from TD Cowen.
Yeah, hey, I wanted to go back to the downstream business and ask about the free cash flow growth in the refining and marketing of $4 billion. Or, sorry, that's the absolute number, $4 billion of free cash flow. Two parts. One, has that kind of mid-cycle assumption changed from the prior Investor Day a couple of years ago? I think historically that business had done something closer to $2 billion. And then part two, what is driving that kind of cash flow, net cash margin growth? Because you didn't call out any discrete projects in the refining and marketing business. So just wondering what's driving that cash flow growth. Thanks.
Thanks, Jason. So just to be clear, the $4 billion of annual cash flow from the downstream is refining and marketing. So the chemicals business would be separate from that. So it's really the R&M side of the equation. That's at mid-cycle margins. Some would argue today that at least for the next few years, we might be above mid-cycle margins, at least in the refining sector in the United States, given some demand and rationalization that's going on today. We don't have to spend a lot of money. We've worked hard on our downstream portfolio to keep it really, really tight. And when we do spend money, it's a high return. So the last project you might have recalled would have been our light tight oil project at the Pasadena refinery, where we got up to 120,000 barrels a day of light tight oil now in. That project has already exceeded expectations both on volume and return. So we don't have to put a lot of input into the downstream business, especially refining and marketing, other than to keep it running reliably, obviously. So I think you can feel pretty comfortable about the $4 billion. Question would be, is there upside with margin here in the next couple of years?
We'll take our next question from Devin McDermott at Morgan Stanley.
Hey, in Mike's remarks earlier, he talked about new country entry in the Middle East and North Africa specifically. I was in the Middle East myself last week, and there was a lot of chatter around the U.S. majors coming back in to the region. Could you characterize the opportunity set a bit more for us? Is this emerging exploration opportunity? Is it stepping into existing fields that have cash flow today? And as part of that, would you all have appetite for another mega project in the region now with TCO wrapping up and having that in the rear view?
Well, I think the short answer might be yes to all those things, but maybe let's step back. I'd like to take a minute and just, because Mike mentioned it, think about the exploration space in general, because this is about bringing new resources into the equation. And you're right, we have entered, in my prepared remarks, I talked about 10 new basins. That's almost double the entries of our competitors. So this is serious about us creating more opportunities to apply this new talent that we have brought together between the Hess team, the Chevron team, and our new external leader of the exploration organization. We talked about spending more and having more opportunities, right? So that kind of makes sense. When I think about the Middle East and you think of Iraq, we have both there's a lot of onshore opportunity. There's discovered resource. There's DROs that we can do, and there's new areas to explore. We would look at all of those. The same would be true in Libya. We're active today in the partition zone. We've been doing polymer flood testing there for the last 18 months. We're drilling some additional exploration wells as we speak. We know how to do business in the Middle East. The conditions just had to warrant it. And as Mike addressed, the conditions, they could compete now. And so you should see us continue to focus on the Middle East.
We'll take our last question from Alistair Syme at Citi.
Thank you. It was actually another question on exploration. You mentioned a 50% increase in the capital budget. I mean, that's a huge scale up. Can you talk about the organizational capability to do that, given, I guess, it's been de-emphasized for some years?
Yeah, I would, first off, I think because of the kind of the world-class shale portfolio that we had, we were able to step back a little bit, and now we're stepping back in. So it's 50% from a relatively small base, and then we will continue to ramp up. So if I'm going to go back to the talent that we brought in, and then maybe the tools that we now have. So again, this combination of the experience that Hess had in looking at different basins than we were looking at in some cases. So it's really nice to bring that talent together. And then our new leader, we've already gotten that group together to test the prioritization of what we're going to invest in. You should expect us work our way back up to 16 to 20 exploration wells a year. Half of that will be infrastructure based, so near existing assets, and then half should be frontier over time. And I think that ramp up will take us a year or two to get to that kind of level. You could expect in the next year or two us drilling exploration wells in Equatorial Guinea, in Namibia, Nigeria. We talked about the partition zone, the Gulf of America. That's just the start. And so I think the way I would think about this is our ability to drill and execute wells is actually really strong. When you look at the last couple of years, every exploration well that we've drilled has been drilled on time and on budget. In some cases, they just didn't find anything. That's the outcome that we're trying to change. The data that we now have available, this is the part that gets a little bit exciting for me when you think about one of the tools that we showed here in some of my prepared remarks. We talked about ocean bottom node seismic. We talked about, you've heard of elastic full waveform inversion. Those are, for those that like to get technical, those are simply two things that allow you to, it'd be like me looking at the right part of my glasses, right? I get a clear view if I look through the right part. It gives you a better resolution of what you're looking at. We showed on the screen something called Apex and spatial high grading. Apex is what Jeff mentioned that gathers all of the exploration material that we have in the company so that people can assess it given the years of experience that we've had. And then spatial high grading, it would be like Zillow. Zillow for leases. It helps you accelerate where you would choose to make decisions about which leases you want. In addition to the new tools, we made organizational changes that make it faster for us to make decisions. And I think that's evidenced in the basin entries and the acreage that we've acquired over the last couple of years. So we're on our way, and you should keep asking about it so that we can show that we're getting the right kind of outcomes. Thank you, Alistair. All right, well, listen, I just want to say thank you. Thank you all so much for joining us here in person and via webcast for Chevron's Investor Day. You know, Mike said it at the beginning, and I'll leave it with you now. Never in my career have I seen a higher confidence outlook further into the future with lower execution risk. We're excited about our future, and we're happy we got to share it with you today. Thank you, and please be safe. Cheers.